Thanks for joining us. Such a pleasure to have with us today Steve Leonard, founder and chief investment officer of Pacifica Capital Investments based in Southern California. Steve, welcome to the program.
Well, thank you. Thank you for having me.
Really look forward to learning from you. There's lots of wisdom and experience. Perhaps it would be instructive before we get into the topic of value investing and understanding from you how you think about value investing. If you could tell us a bit about your path. It's a bit of an unusual one, and tell us how you first got interested in investments.
Sure, and I do think it's instructive to how we do look at all the investment decisions that we make. My career started right after school at UCLA in Los Angeles, where we began to invest in commercial real estate. Our focus was on a particular market that we knew quite well, and a particular product type that we also knew quite well. And we were local brokers, managers, and developers, and so we knew the features that we wanted to find in a property that we were going to own. We knew the values, the costs, the rents, the competitors, and it enabled us to make an informed decision about what value was. And from there, all we had to do was then buy something for less than value, or build or create a new product into a market that was improving in value. And it was fairly simple. And when the competition became too intense and the values became overdone, then we knew that it was not safe to make the investment.
And tell us a bit more about your experiences in real estate. Give us a sense of how you went about building the business and making the right investments, avoiding the ones that you had concerns about, and how you managed the various cycles.
Sure. Well, we really started in the early 1980s, and fortunately for us at that period there was a recession that did adversely affect commercial real estate values, particularly the industrial product type that we focused on. And in our market, we were able to find several opportunities to invest and buy projects for ourselves and for our clients. We invested together. The markets improved, and we enjoyed the appreciation and the income from the investments. But as typically happens, the markets became overheated as investors became more and more excited about the improving economics, and they bid up prices to unreasonable levels, and they began to add new product at unreasonable rates. And so we became very cautious. By then it was about probably the mid-1980s, and quit doing any new investments in Southern California. And it was frustrating to us because we were kind of just getting started, and we wanted more opportunities, and we had very happy clients who wanted us to find more opportunities for them. And so we said, well, how do we do this in this kind of environment? And fortunately, not all of the United States was suffering or at the same point during the cycle, the real estate cycle, if you will. And at the late 1980s, it was Texas and Colorado that had suffered a great recession and overbuilding and a real decline in values. And so we decided that Colorado was the best opportunity for us, and I actually moved with my wife in 1990 essentially to Denver, Colorado, and there we started buying, investing in properties with our clients' equity from Southern California. And first we did one property, then we did two, and then we did 10, then we did 20, 30, 40, and next thing you know, over the next several years, we first bought and then developed the largest portfolio of commercial real estate in Denver, Colorado. The cycle ran its natural course. It recovered. Rents rose, values rose, capital flows returned, and money started to come from Wall Street. During that period, they were starting to fund the public REITs. They were the type of competition that we were not really looking forward to challenging because their return expectations were much lower than ours. And so we sold our portfolios to these public REITs in the late 1990s and took that opportunity then to step back from what I had been doing, which was almost exclusively commercial real estate, at least for our outside investors, and take a shot at doing what I had always done for myself, which was investing in public equities stocks.
So tell us then what you really took from your experiences in the real estate world that you could apply in the world of public equities. What were the key lessons for you?
Well, great question. First was to be focused, be local be an expert and only invest in markets and product types that you have a better understanding than your competition does. So, for instance, when we went to Denver, we bought industrial and office properties in Denver. We didn't try to go to Salt Lake City or Dallas and buy medical buildings or apartment buildings. We were just very focused on what we did. So we concentrated our investments in the areas that we knew best, where we knew the values made sense. And I mean, the old adage, well, don't put all your eggs in one basket. We don't prescribe to it all. We think you do want to have your eggs in a very concentrated basket, and then you really want to understand and value that basket, watch it, know where it is, and that's what we did with commercial real estate. And so we use the same philosophy when we look for public investments in public companies. First and foremost is we're only going to invest in a sector that we think we understand. We can pick the winners and the losers from each other. We can have as much information and insights into this sector as anyone else, and then make a very informed decision about whether this is an asset, a business that we want to own over the long term. If it meets that criteria, then we'll look deeper. Does it have sustainable competitive advantages over its competitors? How the management key in commercial real estate, we manage our own properties, so we had control over that very important aspect of it. When you invest in a public company, you have no control over management. You might be able to talk to them on the phone and suggest a few items, but you really have very little control. And so it's key is to look at two key aspects of management. First is to see if are they running their business, the way you want them to. Are they making a good product, a good service? Do they have happy customers? Are they outdoing their competitors, etc.? And then also equally important is, does the management then do good things with the profits they make? It's the profits are essentially the shareholders' profits, so it's your money. What are they doing with your money? Are they reinvesting it wisely to grow their business? Are they paying out dividends, increasingly large dividends? Are they buying back their stock? And if so, are they paying good prices for it? Or are they buying it at any price just in order to not have to pay out a dividend? Those are very important capital allocation decisions that management makes, and the board, that we look very careful at. And then finally, again, we learned in commercial real estate, you in order to have a safe investment and to earn an attractive return over a sustained period of time, you need to make the investment at a favorable price. And so it's just not a matter of finding a good company that you know something about, but you also have to have the patience and discipline to invest only when the price is favorable. And often that can mean a great deal of patience.
And before we get into learning from you more about the various aspects that you just mentioned, I'd be curious to understand that aspect of leverage, which certainly is an inherent feature of the real estate investing area. But as value investors and looking at the public equity the way you do, give us a sense of the role of leverage and how you see that across those two asset classes.
Okay, another good question. So similar to the management issue, in commercial real estate, we did our own management. We made our own leverage decisions. How much debt to put on an investment property, what type of debt, the term, the fixed rate, variable rate, etc. When you invest in public equities, you really have little to say about the management. You can just say no or yes. You're willing to be a silent partner with them, or you're not. And similarly, they make the decision about how much leverage the business employs. If it's highly leveraged, you need to be careful, for sure, because it's their decision, the management's decision, and the board's how much leverage to have, what type of terms they're going to take, and they can change at any time they want. So we're very careful. We consider that part of judging the management, how they allocate their capital resources, how much debt they have, how they use their retained earnings to grow their business.
And perhaps that leads us into talking a little bit about some of the compromises that an investor may need to take, or what is the judgment with regards to the various areas, great business, great management, great price. Often it doesn't happen that way in the real world. So give us a sense of really where that discipline comes in, and which compromises you are or are not willing to make.
Okay. Well, again, when you do make compromises, you increase your risk level. And so we're very careful about the compromises, at least we try and be very careful about the compromises we make. We just very rarely stray from the idea of investing in something that we think we understand the sector and the competition and the industry and the consumer dynamics of it very well. Next, we look at, does this business earn a high return on the equity invested to sustain it? Does it have a sustainable competitive advantage? Now there, conceivably, we might make a compromise if we're making, similar to real estate, a more of a cyclical play where we know that the industry or the sector is in a low point of a cycle and is going to recover, and we can play that upswing, if you will. An example that we're considering even today in the public stock market is the single-family home market, new construction. There, it's not a high return business, but it's very cyclical, and if you can invest when it's somewhat down and you have confidence in the recovery, then it might not meet the qualifications of American Express or Starbucks, where you have these great brands that earn high returns, but the safety of knowing that the recovery is likely to last a decent period of time, and that margins and profits are going to improve as the cycle progresses, is one of the compromises that we will occasionally make, even though if we do, we will limit the size of our investment, the amount of our investment. The other thing we look at, as we talked about, was management. Boy, it's better not to make a compromise there. If you don't have confidence and faith in management, we found that even with good businesses, managers can make poor decisions that can dramatically adversely affect your results. And likewise, if the business isn't great, but the management truly is, then we'll be a little bit more willing to consider that investment. Again, very price sensitive, and limit the amount of capital we invest. And then finally, the last criteria is price value. And again, you can compromise more the more you have the other things work to your advantage. You understand the business; it's a sustainable, high return business, and you think the management is good. Well, if you overpay a little bit, you'll come out fine over time. You might not make as much money as you otherwise would, but you'll still come out fine over time.
And let's perhaps focus on situations that lead to mispricings of great businesses with great managers. So what are some interesting areas that you look for to find such businesses with great managers that are actually available at attractive prices?
Well, and this requires real patience and discipline, but the easiest way is to wait for a big recession. And we had one in 08, 09, and so if you had dry powder, which fortunately the accounts that we managed did, because we had a very strong market ahead of that, what we thought were inflated values, and so we were able to use that opportunity to sell out of many of our positions and build a cash balance that we waited, and the market suffered from the recession of 08, 09, and there were some great bargains for some great companies. But you don't get that opportunity very often. And so more specifically, well, sometimes it can be management changes. If the problem is management, and then they replace the management, then that's can be another easy opportunity. We're a little bit skeptical when the same board changes the management and there's no change in the board, because the board should be as responsible for the performance of the company as the management should be. But we do look at management changes as opportunities. We tend not to look at technology quite as much as an opportunity for us, because when it can change to help you, can also tend to be able to change to hurt you, too quickly for us. But technology does change, and you have to be aware of the effect on the sustainability of this business model that you're looking at. Another example, go back to my real estate days, is that when we owned portfolios of commercial real estate, we every year had to buy property and casualty insurance. And so we got to know that industry quite well. And not dissimilar to the commercial real estate industry, we learned that the property and casualty industry has its cycles. There are what they call hard markets, where underwriting is the supply of capital available to underwrite insurance policies is tight, so the rates go up. And conversely, there are soft market periods and soft markets, and the opposite occurs. In the 90s in Denver, when every year we were enlarging our commercial real estate portfolio, and we found that our insurance policy, the price actually either was the same or went down. So that was a period, the 90s, of developing soft market. And eventually, the cycle bottoms, and it did, and then we saw commercial property casualty rates increase. We started buying property and casualty insurance companies. And fortunately, we picked the best, Berkshire Hathaway, another one based in Toronto called Fairfax, etc. And so they proved quite rewarding for us through the early 2000s and beyond. Now, there was an interesting interruption. The 9/11 terrorist attack caused a great deal of loss in the industry, and it resulted in a tightening market as capital was drained off, and people were a little afraid of the industry, and so we were able to increase our investment and enjoy very strong returns in the subsequent years.
So that's interesting when you can find sort of cyclical situations that turn out to actually then be compounders like Berkshire. What a wonderful approach that is.
Well, both Berkshire and our Fairfax investment, we made our first investments in the year 2000, which was a couple years after we started. And Berkshire was I'm going to get my numbers wrong here, but it was considerably lower when we first started buying it in the year 2000 than it was when we started in 1998. So we always knew we wanted to own Berkshire Hathaway, but again, price matters. And this was during the ending of the tech bubble, but while the tech bubble was still bubbling, the wisdom of Wall Street said that Warren Buffett had lost his abilities to understand, how to make investment decisions, and they punished his stock unreasonably. It was the tail end of a soft market in the insurance cycle, and it was just a great time. We bought some shares very close to book value, and we still own them today.
Let me ask you about the role of government and regulation when it comes to mispricing opportunities of great businesses, great franchises. Do you get attracted to those types of situations where an entire industry may sort of fall out of favor because of increased government intervention? And how do you judge that?
Okay, good question again. An example that we did not participate in, but maybe we should have, was the cigarette industry. When they finally made the massive settlements and the governments re-regulated or overly regulated, almost inevitably, when the government regulates an industry, it ensures that the large established players win. Okay, because they really prevent new capital, new competition from entering the markets. And so if you bought a basket of tobacco companies, you would have made quite a bit of money over the ensuing years. Likewise, during the financial collapse of 08-09, the government regulations in the industry have come in very strong, and they're still evolving, and they've more created winners and losers, but fortunately we identified what we thought were the strongest players, both within their particular arenas of the financial markets, financial industry, and with the best management. And so, for instance, when we looked at the national banks, we said hands down it's Wells Fargo, and the government with their regulations and some of the forced mergers, they brought it down to 4 national banks, and 2 were severely handicapped, Bank of America and Citicorp, because of all the problems they had. Well, Wells was unscathed, had the best management, and able to dramatically pick up market share and perform quite handsomely for us. Regional banks, to some extent, the same thing happened. We found U.S. Bank. We knew them from being on the western part of the United States and their track record and their management, and it was an easy pick for us. In the investment banking arena, we thought we picked Goldman Sachs. We thought that they had the best global franchise, best management, and they have done well. Their stock performance has not been quite as strong as maybe Wells Fargo and U.S. Bank, but we're still an owner of Goldman Sachs, and we think they still have a decent amount of upside. Their competition is not as strong as it used to be. The regulations do have some effect on their short-term results, how much leverage they can use and what kind of investments they can make, but we feel very comfortable that over the next several years that they'll probably have a very nice results for our investors.
I'm curious about another industry that's been in the press a lot, certainly an important industry, education, and the for-profit players. I don't know if you looked at it, just curious how you would judge a situation like that. What would be the thought process there? Perhaps realizing also that technology link which you talked about earlier.
Yeah, it's too hard for us, and so we don't even look, to tell you the truth. My kids are just going away to college, and I know a little bit about colleges, but I don't understand exactly where the demand and the supply and who the best players are in the for-profit educational markets, so we don't go there.
Could you perhaps share with us how your approach has evolved over time in the public markets with the criteria that you talked about? Perhaps talk about some situations that haven't perhaps worked out as you had expected, or how perhaps you have just tweaked your approach over the years.
Well, an example of something that didn't work out nearly as well as we expected it to was back when we started. I had a daughter who was a young 8-year-old, and she was getting Barbie dolls right and left, and so I said, gee, if I own Mattel, I'd love to be able to sell for $12 a Barbie that costs them $2 to make, and 3 days later they're ripped apart and they got to get a new one. I wasn't smart enough or experienced enough to realize, though, was that management was not what I expected them to be, and they made some terrible decisions, not only in operating in the day-to-day part of their business, trying to force Barbie sales upon retailers, but also they had excess profits, and they used it to invest in new technology-oriented children's toys, and they made terrible decisions, and they made an investment in the one company called the Learning Company, I believe it was, and they spent $1 billion acquiring this company, and 2 years later they sold it for $1. And so I learned that it's not just how good the brand, part of the business brand might be. You really have to understand management.
What do you look for then in management to assess those two key criteria that you talked about earlier? How capable they are, and then how honest are they with minority shareholders?
Okay, so I'll give you a good example for us. So one of the first investments we took a very large position in back when we first started in the late 1990s was Starbucks. And that was an easy one for us to judge how management operated the business, because all you needed to do was go to one of their stores and see if they had happy customers, if they had happy workers, and it was a pleasurable experience, and people were willing to stand in line to pay up for a cup of coffee, and we saw that. And then we traveled around. First it was only part of the country, but then it quickly grew to be all over the United States, and we went over to Asia. The first stores were in Tokyo and then in Singapore, and we went to Tokyo and Singapore, and we were very impressed with what we saw, how they ran their business. And so we took a major position in Starbucks. Even though we paid a big multiple, we could tell at the time they had like 500 stores or something. We could tell that they're going to have many more than 500 stores over time. We maybe didn't know they were going to have the 20,000 stores that they have today, but we knew they were going to have, a multiple of 500 stores. And so we invested very heavily. We saw their execution was very strong, and they occasionally had little gyrations in the stock price, sometimes for real reasons, sometimes for not, that we took advantage of and added to our position. However, as time went on, we started to notice that while they still continued to run their stores pretty well, the board and management, in order to maintain their high stock multiple when they went from 500 stores now to 5,000 stores. They continued to lead Wall Street to believe that they could continue to open stores at the same pace, even though they were now a much larger company, and it was going to be harder to find good locations that could earn strong store economics in the United States for sure. And they wouldn't pay a dividend even though they had strong free cash flow, even after they allowing for the development of new stores. And they gave out stock options like candy. And they were part of the controversy back during this period of the early 2000s where they maintained that stock options shouldn't be counted as an expense on their profit and loss statement. And it wasn't just a coincidence, in our opinion, that they were willing to give out, they didn't want to count stock options as an expense. They gave out an excess amount of them, and they weren't willing to pay a dividend. A dividend hurts the value of a stock option, okay, because it takes away some of the value of the company by giving it to the current owners, not the future owners. And so we got a little uncomfortable with management's capital allocation decisions and their growth expectations as far as they were literally building stores on top of stores in the United States. And so we, for our clients, we completely sold out by approximately the year 2004. And we still liked the business model. We still thought their store economics were as good as anybody's in the industry. And we sat there and said, gee, you know, if management changed the tune and if the stock price becomes a little bit more reasonable, because the multiple, quite frankly, to earnings was as high when they had 5,000 stores as when it had 500 stores, and we weren't comfortable with that. And so we watched it, and over the next few years, you know, stock price edged up a little bit higher, but we became even less comfortable with what management was doing, and then they started to stumble. They had some, for the first time, declining same-store sales because they had too many stores too close to each other, and they were now taking on debt to buy back more stock. Eventually, they were not going to be able to take on more debt to buy back more stock, and et cetera. And so the share price started to tumble, and it went from, you know, the mid 40 range-ish down to 20. We became very interested again, and once it got below 20, we started buying. Now, maybe we should have been more patient, but we first bought at 18, and then 15, and then 12, and then at 10, and it even went below 10, and we were still buying. And we're glad we waited. Management said, okay, no more share buybacks for a while. They did fairly soon afterwards pay a dividend. They slowed down their new store growth, more focus on return on invested capital, and all the things that we believe they should have been doing all along. And we established a fairly large position again. Now, maybe the mistake I made, though, is when it went from 10 to 12 to 15 to 20, I should have continued to buy, because, you know, that under 20 back then was a very, very attractive long-term price. And today it's, you know, considerably higher, and we're still an owner, but we wouldn't buy at this price.
But you started buying with the same management in place, and give us a sense of when then the founder came back and how that sort of influenced your decision.
I don't think it was so much the founder, Howard Schultz, came back, because he was always there. He was always on the board, chairman of the board. But they did publicly announce that, yes, we are not going to buy back stock, at least for a while. We have a goal of starting to pay a dividend when we get healthy again. We're going to slow down our expansion and focus on return on invested capital. And the stock price changed dramatically. It was way more than a 50% decline. And again, we went to the stores, and we see people standing in line and to have a cup of coffee or taking it out to go. So the store economics were still very attractive. And so it was more, and they made a few management changes, but they changed their the philosophy of how they allocated their capital resources. It wasn't so much a change in how they ran their stores, because we always were fairly impressed with that.
Help us understand a bit how you think about circle of competence. And you mentioned, if I remember correctly, the first criterion, the first filter is, do I understand the business? So which types of businesses have you perhaps expanded your circle of competence into over time? And give us a sense of how you think about that process.
Yeah, I'm not sure if we really have expanded it too much because I'd rather stay more focused on the things that I'm most knowledgeable about and that are easiest and enjoyable for me to try and be an expert on. Now I have a partner, Carrie, who works out of Austin, Texas, and she has some knowledge and experiences that I don't have, but we're fairly focused on consumer-oriented goods and services, and partly because of my real estate experience with borrowing money from banks and buying property and casualty insurance, so the financial industries we know something about. We were able to take a fairly decent position in American Express during the financial crisis. Well, I picked that up from my wife. She wouldn't give up her American Express card, for anything. And in fact, we're in a nice hotel in Beverly Hills right now. And we have an upgraded suite just because we have an American Express card, and she loves it. So those kinds of things. Maybe I should have listened to my daughter a few more times. Not so much about Barbies, but boy, back when she was a young teen, she was buying all her clothes from Abercrombie and Fitch. And if I had paid attention, that company did very well for a particular period of time. And quite frankly, I said, I don't see you buying that product anymore. She goes, yeah, they're not good anymore, Daddy. And next thing you know, the stock did much poor, or didn't do well at all. So you can learn from people who know more than you. You gotta listen. You gotta get out. I travel quite a bit. My wife and I just came back from a trip to 2 nights in Houston and 2 nights in Charleston, South Carolina. Now, we really hadn't been to those cities before, and so we wanted to see them because it's fun and enjoyable. But we also, whether you're walking through the airport or downtown or whatever mall in Houston, you see what's going on in the what the consumer is embracing and what they're not. I made a terrible mistake, if you will, with Apple. I had a friend call me up 10 plus years ago and say, gee, I just got this new product from Apple. It's called an iPod, and I got all my music in my palm of my hand. And I said, yeah, but that's technology, and they don't really sell their PCs very well, their desktops. And I said, so I don't think I'm going to go there. And he says, oh, gee, I think it's really good. Well, I should have listened to him. I should have done some research. But I didn't get my first iPod until years later, and I didn't understand. Because of that, I wasn't an active participant. I didn't understand that library that you created that only worked on their hardware, you were married to Apple. And they got such a loyal following. And then came out with good products after that. And I missed that. Well, Starbucks I didn't miss because I drink coffee. So I was able to I go to Starbucks still almost every morning. And, when they start, treating their customers poorly, I'll know it before Wall Street knows it.
The example of Apple is instructive. I'd be curious to understand from you this role of technology and do you really think that there is something different here and people sometimes use labels wrongly and say it's a technology company when it's actually something else? Perhaps IBM with Warren Buffett, give us a sense of, how you remove yourself from these labels, and when you look at a business first, what really matters in terms of the business models that you really favor and get attracted to?
Fair. So Apple, for instance, that's on a borderline for us, which we try and debate whether we think we have the ability to really understand and predict its future position in the market. We more or less decided we're probably a little too hard for us because they do need to have a better phone or as good a phone as Samsung, et cetera. Otherwise, they're going to be in trouble. I mean, they have a loyal young customer base, but that could change over time. And we don't know of too many technology companies, consumer technology companies, that have stood the test of time. Okay. That said, we thought about IBM, particularly after Berkshire bought their large position, and we easily concluded that was too difficult for us. We're just not in the market of consuming their products and services enough to except for hearsay, we could ask a buddy who works at some company who consumes their product and services, but that's not close enough for us. However, a different example is Amazon. I mean, a tech company, I guess, but gee, they're really, as much as anything, a retailer. And so we do think we would have a chance, particularly the old Amazon. Now, the new Amazon is evolving to be much more when they're trying to compete now with Netflix and come up with their own phone pretty soon, and all their cloud services. So, but if you just look at the retailing side of them, we can try and understand their cost of goods sold, their profit margins, et cetera, and have some idea how to value them. Now, that said, we can't get to the value the market gives them today at all, so we don't go there.
And how important is the role of Bezos there in terms of the great manager to kind of perhaps make some compromises on the business side if the price was, let's say, more attractive?
Yeah. We haven't actually spent the time, we haven't become comfortable enough with Amazon and their business model, and never seen on first blush a price that was, or not for a long time, that was reasonably attractive, to spend enough time to really form a solid opinion on Jeff Bezos and whether we would invest with him or not. So I can't answer that because we haven't done the work.
You talked about focused investing, in, both in real estate and now in public equity markets. A lot of people say they're focused, and when you look at portfolios, some people have 10 positions and they think they're focused. Others have 30 and they think they're focused, or 50. It would be great to hear from you what really focused investing is all about. How do you think about that?
Well, we share the Buffett philosophy of putting more money where you're most comfortable. Why would you take a portion of your money and put it where you're less comfortable if you could still put it where you're more comfortable? And so, and we don't have the problem of size that he has. So we can, buy as much of Starbucks or American Express as we want and never have a problem. That said, we'd rather not just own one company, even though there was a period where Starbucks was the substantial majority of our investment portfolio in the late 90s, and we're glad it was. Today, if it's a mature account that we manage for one of our clients, where we had the advantage of being able to buy during 08, 09, when there were a lot of good opportunities for us, we probably own about 10 positions, and a few not dominate, but a few are substantially larger than some of the other ones. The Berkshire Hathaway position, our Fairfax position, and Starbucks was also a very large position for it. Now, in the accounts that we manage that are not taxable, we don't have to worry about the tax consequence. We've sold quite a bit of the Starbucks, but we think it's a little harder decision to make when you're forcing your client to pay a fairly large capital gains tax. I live in California, so I know how that can be. And so we might, again, own 10 positions, and 2 or 3 companies will probably equal maybe half the portfolio. And to us, always one of our positions is cash. Now, it can get to be a very, very small position, which it did in the mid-09 period, but it can also become a very large position, which it was in 2007, in which it's now becoming, again, particularly in our non-taxable accounts. If it's a newer account that's opened in the last few months, let's say, it's been hard to make investments. And so they're very concentrated in cash.
How important is the global opportunity set for you? I imagine, again, the challenges perhaps of not knowing the market or not knowing the country, the consumer habits, but give us a sense of, with that mindset, looking for brands, and brands are becoming more global. I shouldn't say looking for brands, looking for focusing on consumer-oriented businesses. Has that taken you outside of the U.S. much?
Well, yes, in a sense, but we do it by investing in North American-based companies who we think have growing opportunities outside of the United States and Europe, and outside of Japan. So the obvious ones, China, India, Brazil, etc. There'll be stronger growth, rising middle classes, and companies like Starbucks and American Express and many others will do well. Now, I do make it a point to travel, and in fact, one time we took our our family, our kids out of school, and we went in a sense around the world, but we didn't directly just circle the world. But we went to many different cities, and we started to play a game. Okay, when we land, let's see who can find the first Starbucks, or we didn't do Coke, because you can't even get off the airplane without seeing a Coke machine. But we looked at Starbucks, and we looked at some of the banks, and we looked for these brands, these global companies. And I came back from that trip, and I think it was around 2006, saying, gee, I'm amazed how strong internationally Citibank is and HSBC. I said, these are two really dominant global financial institutions. I'm going to look into them. And so it was easy to look into Citibank, and after a little bit of research, I said, oh my goodness, this is dynamite. I don't care where they have branches and a presence. They are not who I want to be a partner with. And so we did a little work, and we learned that we quickly saw that was not a place to be. But the idea of seeing that Citi had a strong position probably saved them, quite frankly, could have been an opportunity for us. In 1999, my wife and I, we went to Tokyo, Japan, where Starbucks opened their first international stores, and then we went over to Singapore, where they just begun to open stores. And in the same mega hotel that we were staying in, they had a Starbucks on the ground floor. And so first thing I do, get up in the morning, and I go to Starbucks at 8 o'clock in the morning or whatever time it was. And, in the United States, at that time, the store would be very busy, and the store was only modestly busy. And I said, this isn't so impressive. So we did our sightseeing in Singapore and had lunch, and I came back after lunch, and boy, now the store was pretty busy, and more so than you would find in the United States for the early afternoon. And so then we did more sightseeing and out to dinner, and then I told my wife, going back to Starbucks. She goes, I'm done going to Starbucks today. So I went back by myself. Now it's 10 o'clock at night, and the store is packed with young people. And I said, boy, now I see what's going on here. If they can do this kind of business late at night, they've got some real strong store economics with young people who are going to be longtime customers, this is a winner. And so immediately when I got home, increased the size of the Starbucks position. So that's what you can see when you get out and you look, and you stick with something that you know something about.
What do you think is perhaps underappreciated, even by value-oriented investors, when it comes to these franchises, well-known brands, consumer businesses? What do you look for really to give you confidence that this is really a good long-term investment, perhaps related to the business itself, that you think sometimes is underappreciated?
Well, stronger brands tend to be sell a product or service where the cost of the product or service is relatively low to the value perception of the consumer. So Wrigley's chewing gum, when you're at a checkout stand and you can buy a pack of gum for, I don't know, 80 cents, whatever it is today, versus buying a generic pack for 60 cents, it's for 20 cents and for 8 sticks, it's not worth it to take a chance. And so that's easier to see the value in that brand. So that's one thing. It's harder for BMW to have their, when you look to buy a BMW, chances are you're going to also go look at Audi and Mercedes and whatever else. And so there you still have to have a better product or a better price or something in order to win over the consumer. And so we tend to look at products and services that are more lower price per transaction. We also tend to want to see acceptance by the younger people because they tend to be early adapters to new ideas and new brands, new products and services, and they tend to live longer, so they can be a longer customer. You know, if you go in a restaurant and you see only older people, you have to worry about what is this business going to do in 10, 20 years if all their customers are gone. So,
what about some of the high value perceived businesses, products, the luxury products that really seem to be taking advantage of some of the income trends around the world, and investors have sort of flocked to those as really sort of safe investments. Nothing can go wrong. These brands are unique in a sense. How do you evaluate those?
Well, we haven't really participated in that sector specifically, and so I'm probably not the best one to judge, but I can tell you in a general sense that those sectors tend to be most affected during an economic downturn. And so if all you did was wait for some kind of economic downturn and buy some kind of basket of high-end retailers and products, etc., and then just when the economy was good and everything looked great, you just sold, you'd probably make a lot of money. Because the high-end stuff is not immune. People said that about the high-end housing market because it was the last to go down, but boy, it went down further than anything else when it finally did go down. And so you have to be careful.
Some investors will look to these franchise businesses, and Warren Buffett certainly has advocated investing in such great businesses as a protection against inflation and businesses with pricing power. I'd be curious to hear from you how you think about the low interest rate environment today, and as people are sort of investing in various asset classes, whether it be bonds to get income or anything else. Give us a sense how that's affected your process approach, just the record low interest rate environment.
Okay, I'm going to do that one first, but then I want to come back to the first part of your question because I think that's also important. Yeah, today in our accounts when we have cash in the money market, it earns almost nothing. So it's frustrating to us and it's frustrating to our clients. That said, it's better to earn almost nothing than it is to lose. Okay, and so we try very hard not to be caught up in the idea of making short-term income at the expense of not only safety risk, but having a dry powder for when the market does give us good opportunities again. So we are not out there saying, gee, how can we earn a better return in the short run on our excess balances? We think people, in a general sense, people who are buying corporate bonds over government bonds, they're getting paid so little for the additional risk that they're taking that we don't understand it. And you can look at the charts out there, graphs that show historically, when the spread between high risk and low risk is narrow versus when it's extreme, and it's an easy call to make. Right now it's very narrow and it's just not worth it. Now, that said, we don't buy bonds. To us, bond is an instrument that best case, you get your money back, plus whatever the interest rate is that they've agreed to, and you pay, unless a municipal bond, you pay full taxes on it, and so the after-tax return is limited, and we don't see the advantage of it. If we were going to look for a higher yield situation, we would consider commercial real estate, because not only then you have a chance at increasing returns from future higher rents, but you have a chance of appreciation over time and debt amortization, which again can build equity. I want to make another important point here, because when we started Pacifica Capital Investments in 1998, I now had some liquidity from the sale of the commercial real estate portfolios in Denver, and so I needed to invest my money. And I had happy clients from the commercial real estate investment days, so to speak, who wanted to continue to invest our money. I said, this is what I'm going to do, and we started Pacifica Capital Investments. Since 1998, we've had several events that have affected markets in the world, and from 9/11s to dramatic political changes to wars in the Middle East, to tsunamis in Japan, to housing bubbles, high-tech bubbles, you name it. And if you worried about all these things and said, gee, I'm going to stick my money in gold or in a mattress, you would have been far worse off than if you invested what we did with our money and what our clients did with their money in these good businesses that occasionally sell at attractive prices, and then you more or less hold for the long term to compound that return without sharing your gain with the government and paying taxes. So we expect over the next many years for there to be other events that we can't predict that will be equally as climatic to politics and world affairs. Maybe now over in the Crimea and who knows how that's going to play out. But the smartest thing you can do is take your money and put it in investments that you have confidence in, that have good returns, good economics, good management, and you're patient enough to buy it when it's attractively priced and hold it. And if the world spins backwards for some period of time, you just have to relax, have confidence in the decision you make, and you'll come out ahead.
Steve, is there anything that we haven't discussed that you feel was critical to your success and the investment approach that you take?
Well, again, just emphasizing the discipline of waiting for the fat pitch, and then when it comes across the plate, you need to swing for it. I know for myself, with my money, my family's money, we've done that. We put all our eggs into this Pacifica basket in 1998, and it's worked out very well for us, and we hope we can make similar returns over the next 15 years.
Well, on that note, Steve, thank you so very much for taking the time to share your experiences both in real estate and investing, and giving us a sense of what drives success in both. Thank you.
Thank you.